What's up, guys and gals? Welcome back to another Loose Ventures video. It is September 27th, a Tuesday, and the markets are still going down, which kind of sucks, I think. But hey, just save your money and keep buying the dip, right? Or wait, hold cash. That's probably fine too. I wouldn't blame you for doing that. But hey, finally, I want to go over my watch list and my spreadsheets, my setup here, the process that I go through when comparing stocks, comparing valuations, multiples, all that good jazz. And as I've mentioned in the other videos, that if you haven't watched, by the way, you should go ahead and check them out. My videos on my value investing style and my screening process and the sources that I use. So make sure you check out those videos in addition to this one, so you have a holistic idea of my overall process. Another thing I'll mention is something I've also mentioned before, is none of this is a science. This is my process. This is something I've worked on for years, and it suits me. Some of it might be very arbitrary to some, or to many of you, but it makes sense for me, and overall it's just me trying to check all the boxes when approaching stock analysis, making investment decisions. And just because stocks are on this watch list, or the metrics, everything checks out, it doesn't mean I'm rushing to buy. So there's a lot that goes into this spreadsheet, into my process. So overall, I would just say everything I say here, everything I've said in the other videos, take with a grain of salt. I'm just another guy on YouTube trying to share my process. Goal is to help you develop your own process. And I know I've gotten plenty of questions about my spreadsheets, and perhaps this is one of the most complicated things to develop for yourself. So hopefully by going through my watch list here and maybe just taking a glance at some of these formulas I have set up, it can kind of help you develop your own process. Hopefully it's simpler than mine. It doesn't have to get so complicated, right? But yeah, hope it helps. So that said, let's get right into it. All right, so this is my primary watch list, and I have a few spreadsheets, but this is the one I watch the most. And I guess for starters, so say the stocks you see here, these are the ones I want to be actively watching. They're either already in my portfolio, or I'm looking to add, I'm looking to trim. I'm just watching the companies, carefully, because I'm waiting for an event, something like that. So overall, these are the stocks that I want to keep an eye on. I have many more stocks in this watch list, which I've kind of grazed over on a few of the other videos. And overall, I'll kind of go through other stocks as time goes on. I'll open up this watch list just like I did right now, and I'll kind of update some other stocks just to see if anything meets my price target. So the whole purpose of this watch list is to not just keep an eye on the stocks that I'm very interested in, but also the companies that maybe aren't trading at a good value today, or maybe I'm expecting something to happen at some point in time, and I can keep those on my watch list, and every now and then say, well, the market's moved down 10%, over the past a couple weeks or whatever. Maybe it's time to update the watch list, right? So then I'll open it up, and I'll look at all these other companies that maybe I didn't think were a good buy, and I'll kind of update all the figures, all the financials. I'll do some more research and see if they're a good buy now. I tend to be pretty picky when looking at stocks. I've looked at over, I don't know, like maybe 500 stocks year to date probably, and less than 30 have really made the buy list. So yeah, I think it's helpful to be picky. You could have your own approach where you're kind of diversifying and making each position a lot smaller. Maybe that's like DFV style, something like that. It's up to you. I try to keep a good eye on each stock that I'm holding and each stock that I'm looking at carefully. So I try to cut down on time I'm going to spend overall. Because each stock is given more time, than perhaps somebody that has a portfolio of 100 stocks or more, right? So yeah, essentially, I like to keep it to maybe 20 to 30 stocks. It's I would say a little on the high end. Some of these I just need to look at, like I need to research a few, right? But I'll go over the specifics of each of these columns. So first and foremost, the way I sort, or I guess the way I categorize stocks, is by what I refer to as their markets. And this, I think most people just use industries, right? And also do sectors, and that's one of these hidden columns. But the reason why I do markets is because I want to compare the specific, not just the industry, but the type of business that each company is in. And for example, oil and gas, you're going to have upstream, downstream, midstream, right? You're going to have specifically natural gas, LNGs, all sorts of stuff, right? I want to know which of those companies act very similarly, and not just like in terms of price movement, but how they specifically make money. So that's why maybe these oil and gas upstream companies, maybe I want to categorize them differently than, say, the big refiners or the integrated oil and gas companies. So even though they're very similar in terms of, I guess, the overall sector, or high level industry, to me there are key differences I need to know. And so that's a big reason why I'll do that. Another reason is sometimes, say like Meta's here, I categorize them as e-commerce because they're big on digital advertising, right? I think most people see them as just social media, but the way they make all their money is through digital advertising. So I categorize them in e-commerce, and I look at them kind of from a macro perspective. So I think a lot of investors have been concerned about Meta's guidance for a while now because of the markets that they serve. Digital advertising, e-commerce. So that's probably going to struggle in a recession, right? In a good recession, if that's what we're headed into, if we're not already there, right? So this marking, for example, marking Meta as e-commerce, that's going to make me think about the macro picture, not just like, industry. Now I'm going to compare it to other social media companies. It's not like that. I'm thinking about it from a higher level perspective. And that helps me think about risk, about trends, so this is more of a way of thinking versus what's the strict industry code, right? I'll still consider that, of course, but for other reasons, I'll consider the strict industry. But yeah, this is a way of looking at the business and trying to apply some sort of risk or predictions of trends going forward. And I find this process really helpful. And another thing I can do is I can group different companies, say companies that might be just in different industries altogether. I might just categorize them together, right? So here's so payment services. This is a StoneCo, and they are a Brazilian payment services company, and they kind of cater to, I guess, like small businesses. I think they have like a Square type, a point of sales device, stuff like that. And then you have a company like Visa, right? Well, they're both pretty similar in that they have to do with consumer spending and transactions. So even though they're very different companies, and they're literally in different economies, right? StoneCo is in Brazil, Visa's global, right? I'm going to look at their business. I'm going to think about their business from a macro perspective in a similar manner in terms of overall risk. I know about StoneCo. I know that there's a lot more risk for that company because they're based in Brazil. The economy is struggling, right? But this is kind of, you could think of this as sort of step one, okay? So that's kind of the macro perspective, and then I get more specific as I do analysis of each individual stock. So yeah, that's just an example of how I might group somewhat different stocks together just to get a a unique macro perspective instead of just saying, oh, these companies are in the tech sector. That doesn't really help me that much. Not really when trying to predict the trends of the business and the risk of that particular that company's markets, right? Okay, so by the way, most of this data is coming from Google Finance, vast majority of it actually, and I do have little links here and there. There are a lot of hidden columns that I'll kind of touch on. I don't want to make this video too long, so I'm gonna kind of breeze through a lot of stuff. And if you have questions, just leave them in the comments. And I think I'm doing pretty well about getting back to everybody that's left comments, asked questions. So yeah, I'll get back to you relatively quickly if you have any questions. So yeah, this is the current list of stocks that I'm watching now, and this is going to change a lot. And a lot of the stocks that I'm long on, that I'm just bullish on in the long term, those are probably going to stay for a while. And if anything changes, then I'm going to update them. I'm going to update my thesis. I'm going to find out, okay, do I want to stay in this stock? Do I want to trim? Do I want to add? Whatever the case is. Ideally, I will absolutely keep up to date on each company on at least a quarterly basis. Ideally, I'm going to be checking, like every week to see if there's any new news out, new events that have occurred, because I want to stay on top of these stocks. So yeah, that's kind of like, the bigger the position, the more interested I am in them, then the more I'll read into the 10K, the more I'll pay attention to news, stuff like that. If it's not that big of a position, I'm not too concerned. But yeah, I got all sorts of stocks here, and I'll kind of touch on, I suppose, the different approaches I have as we kind of move to the right of this spreadsheet as we go over to the last few columns there. One thing I like to do here specifically is, rather than have separate documents with all my notes and my thesis and everything, I like to just leave notes here. I kind of just started doing this recently. Some of these I have documents, and I have full theses and bull and bear cases, upside downside risks, like Chesapeake, for example. I have a whole nother document, like a 2-page, 3-page document that I made myself, just nothing but notes. Basically a written report that I made for Chesapeake. But from now on, I'm definitely just going to be taking notes here. I just find it to be very easy, rather than having this whole set of notes, outside of this spreadsheet, because then I could just look right away and I can see everything that I've listed here. So yeah, I just make little comments. And, like Earthstone, I mentioned this one last week, I believe. And the first thing was, what is wrong with this company? Because it appears to be so cheap based on forward expectations. So say that was like the first question I asked, right? And then as I look further into it, you can see that was September 9th. And then the next day in the morning, I found some more stuff about it. And then I just kept finding more information. So I just add my notes here. I just add all of my comments. And then if I forget what I learned about the company, then I just go back to my notes and I just look here, and it's all right here. So it's all, this is probably one of the most efficient things I've done on this spreadsheet in a long time. Just taking the notes just right here. So I find this very useful, and yeah, it's just very orderly. I can just add, this is a home building company that I just found. I think I mentioned this one too last week, and I just left a note. I haven't really looked into them. I'm like, oh, I need to check inventory. They got a bunch of houses on the balance sheet, right? Are those, is there high risk there, right? Are they in high risk markets? So that's something I kind of want to check into. So yeah, there's a link to the steel prices, steel price forecast right there for ArcelorMittal, which is the world's second largest steel manufacturer. So, yeah, they've repurchased 27% of their shares outstanding since June of last year. Yeah, that's a little crazy. So yeah, I'll keep everything right here. Stellantis, I think, I guess Earthstone kind of has the most amount of notes so far. Maybe. It's not too many. But but yeah, I think you get the idea. This is just it's really useful. I'm going to be doing this much more often from here on out, rather than making separate documents. So if you have your own spreadsheet, maybe you'll find that helpful too. All right, this next column H, these are my arbitrary price targets. So honestly, I think all price targets are arbitrary. This is just to kind of give me an idea. This is just another checkbox, in a long list of checkboxes that I have personally. And these price targets are based on projections and forward multiples. If you're not familiar with multiples, you might want to read up on those, like EBITDA, enterprise value, price to book value, free cash flow yield, and I'll include some links for convenience. But I guess this is somewhat of a theme for my videos. Is I kind of assume that a lot of you have a basic level of knowledge of financials and multiple stuff like that. But if not, I definitely encourage you to develop a good understanding. Investopedia is a great website, very accessible. It's all free, right? So, yeah, and those things they're not too. I don't think they're too complicated, and it's a lot of just basic math. So, but yeah, these price targets are based on multiples, mostly enterprise value, EBITDA, some price to book value, depending on what is going on with the company. Free cash flow yield. And those are the main ones. And here and there, I apply like sales figures, forward growth rates for revenue, stuff like that. So again, I say these are arbitrary because, I'm kind of basing them on projections. Projections are going to change, and I try to look about up to 24 months out. As I mentioned in another video, my time frame is anywhere from 3 to 24 months. And for projecting, I'd like to go out about a year and a half, and I think that's a good time frame of, say, whatever's going to happen soon, right? Say, for example, the end of this year. I think a lot of stocks, a lot of companies are probably going to be pretty accurate with their guidance for the next 3 months, right? Like that's almost locked in for a lot of companies. But if you go out like 2 years, well, nobody knows what we're going to be in 2 years. So to me, or like past that point, right? Who the hell knows how much money or what the margin of these companies are going to be in 3 years, 5 years, So I think a year out is somewhat predictable. Asterisk somewhat. We're still trying to make predictions here, which is near impossible, right? But I think forecasts, you can get a lot of forecasts, you get a lot of projections for about a year out. In this case, it'd be a year and 3 months or a year and a half out from the most recent financial statements, probably. And those forecasts, they might not be too far off, And I always try to be conservative. And then sometimes you have cyclical stocks like FCX, Freeport, they're copper mining. So those projections are going to change for sure. So yeah, that's what these price targets are based on. They're based on those projections. And I keep them here. I'll just open that up real quick. So I input all the projections myself here. I input everything, all the financials, frankly. But yeah, and I'll touch on those in a bit as well. So overall summary for the price targets is they're arbitrary. They're based on projections, but I prefer to keep it like a year and a half out max. And I apply multiples-based valuation to them. So speaking of the multiples, and I'll come back to these links here. These are the multiples I go off of. Like I mentioned, EBITDA, sometimes EBIT. Some of these are just, here's like a placeholder. Price to book and free cash flow yield. Free cash flow yield is the thing I pay attention to most, and it's just how much cash is the company actually generating relative to the value of the company, enterprise value, which is market cap plus debt less cash. So, and that's a standard for valuing companies, in the industry, right? Rather than just looking at market cap. So it's just free cash flow divided by that enterprise value. And my hurdle rate that I have up here is 5%. So up here, I got these weird numbers, and these are just figures that I go off of when projecting a price target. So if say this is Activision is a special situation for me, but if based on say 2023 free cash flow, I want to buy the stock at a price where that free cash flow is equal to 5%, at least 5% of the expected enterprise value at that point in time, right? So whatever free cash flow they make on through 2023, I'm going to divide that, or for the year of 2023 rather, I'm going to divide that by the expected enterprise value for that year. So that's where this projection is basically coming from. And I'm going to have all these long formulas. I'm not going to walk through these, but I'll rather just kind of tell you the logic and basically at a high level what these figures mean, because there are a ton of formulas. So there's no way I'm going to be able to get through all these in one video in a week of videos even. So yeah, based on that, it's giving me a price target of $95.52. Not bad when if it's trading at $74.56 right now, right? Well, there's a special case. They're going to be acquired. I think it had a lower price than this, right? But yeah, that's just the idea. And sometimes I might raise this to 10%, and it will apply that 10% hurdle rate, or my minimum required rate of free cash flow yield, to that company, and then it changes the price. So see, like before 5% was giving me 95, now it's giving me a little under 55. So now you're seeing it and see that price target drop to 60 from 76. So now it's the price is definitely too high, right? So I can change this however I want, and I just change that one number, and yeah, it'll just change the price targets for all these companies. And usually I keep it at 5%, and just to kind of keep it uniform. I left myself a little note to have add an option to switch from these weird numbers up here to like desired multiples per stock. So rather than having to change it up here and it changes it for everything, then I can maybe go in and say, you know what, 10% is required for Activision, 15% is required for Chesapeake, 5% for Google, right? I just haven't done it because this spreadsheet is, I mean, it's I wouldn't say rough around the edges, but it did require a good amount of work to get going the way it is. But yeah, that's the basic idea. I have a hurdle rate. I have these weird figures up here that are just called valuation multipliers, and these are just based on well, you know what? I'll just say these are arbitrary too, except price to book. Price to book, it's 1, right? So this is basically how much would the company be worth if they traded at a price to book value of 1. Typically, I'll include this as like a penalty, and take Freeport. How much would they be worth if the stock price reverted down to where it was trading at a 1 times price to book value? And that's below $17. It's at $26.50 right now. So you can see that's a pretty big difference, pretty big penalty, because that's bringing the whole price down. And overall, what I mean by penalty relative to the whole price target is these numbers here that I have, they're being averaged. So looking at Freeport FCX here, the price to book value 1682, free cash flow yield based on the mandatory 5% is $50. And I have an EV to EBITDA of, let's see, I'm looking for 7.6 times specifically. So this is the value if it were to trade at a 7.6 times forward EV to EBITDA. Just like I mentioned, I'm going to look at projections for free cash flow. I'm going to do the same thing for EBITDA. So yeah, that's the price for that. It's a little high, right? Price to book is much lower, and free cash flow is 50, so it's still at the high end. So this is going to average all those numbers, and that's where I'm getting this price target at. So yeah, this might, unfortunately, I'm not going to go too much into this. I'm just kind of walking you through the process, or I guess high level. I'm looking at projections. I'm applying those projections to the stock price to get an idea of what the stock should be worth. Overall, I'm a big believer in that the markets don't care about your price targets. They don't. Stocks tend to trade at ranges of multiples, but projections can change. Copper, for example, projections was probably much higher, 6 months ago, right? And copper prices have really taken a hit, or a year ago. So those projections have changed a lot, and so is the stock price of FTX. So that's the thing. It's not a science. This is just an idea to get an idea of what the stock price might trade at, what the markets might value this stock at if maybe everything goes as planned, right? And just in case it doesn't, I have this margin of safety here. So here it's all over the place. My method is this is kind of like accounting for risk, right? Some people, I know like D of V, he uses literally a number scale, right? And it's kind of like his level of certainty. And maybe the higher, I think it was like the higher it is, then the more sure he is about it, like 1 to 6 or something weird like that. For me, I just use margin of safety. So like the steeper the margin of safety is, then the less certain I am about it. So that's kind of the way I look at that. And then it just really penalizes the price target. Overall, these price targets are not like I better jump in if it's way below. Like you look at Earthstone, it's prices below 11. My price target is 29.70. It doesn't mean YOLO my portfolio into this stock. This is just telling me that really this is telling me, okay, if the market's valued this at a reasonable valuation, maybe compared to the rest of the industry or the rest of the market, right? Then this is about where it would trade at. But that's obviously not the case. That's a big gap, right? So, that requires some more research. So there are a lot of reasons that could be the case, right? And note, I have a 67% margin of safety. So this whole section right here, it gets complicated. I don't always just follow it to a T. These are just a few of the boxes that I have to check when comparing each stock, right? So yeah, and then to the right here, you can see this is projected return. So this is just dividing my price target by the market price. So based on this, even with the 67% margin of safety, it's saying expected return for Earthstone is 175%. Again, that's like ridiculous, right? So this is, I've thought about this and I'm like, maybe I should change this because some of these are really ridiculous, like VET. But yeah, they're just there to they're just an indicator, really. So yeah, that's this gets a little complicated, but enterprise value to sales, I'm gonna base that off of their forward growth rate, the forward compounded annual growth rate in revenue. Enterprise value to EBITDA, I'm going to base that on their EBITDA margins. So the wider their EBITDA margins are, the better the valuation the price will get. I think that makes a lot of sense. The more earnings they have, then potentially the more valuable the company is. That's the basic logic. EV to EBIT is the same thing. And I mentioned price to book, mentioned free cash flow yield. So yeah, and I got a lot of other weird stuff going on here, but I won't go into that. It's probably just going to confuse you even more. Right there, I do have average volume, or at least today's volume divided by, I think it's like 10-day average, maybe. It's all coming from Google Finance, just their formulas. But yeah, I just want to see how the stock's being traded. Like Generac, 196% of the average is being traded, and we still got 2 hours till the close. So that's pretty interesting. What's another one? VET. So that's pretty good too. Oh, they're up 8.5%. Oh, I didn't even notice that. Wow. So yeah, a lot of volume for some of these stocks. And I kind of had it color coded, like blue is it's a little muted, right? Or the kind of like not deeper blue, but I don't know, what is that? What is this blue? It's not baby blue. This is like baby blue. Whatever this is. and then the baby blue is like let's say it's about like 80% to like 120%, and then I have the fuchsia, magenta, whatever we decided that color is. That's if volume's significantly higher than the average. So VET sticks out, Generac sticks out, probably because of hurricanes for Generac, because they sell power generators. So that makes sense, right? But by the way, if you're in Florida, be safe. You got hurricanes headed your way. It seems like maybe even into the Carolinas. So yeah, just be safe. On an unrelated note, I am buying Generac calls just in case those hurricanes really take off. So yeah, or I already bought some. So just a little tidbit there. Let's see. So yeah, some of these decent amount of volume, but a lot of, I guess this might pick up the last couple hours. Nintendo's got low volume anyways, so maybe that's not a big deal. But yeah, I'll just track volume, just see if something sticks out, and that'll kind of tell me something's going on for the day. These seemingly blank columns here. This column is Yahoo Finance, and I have a decent level of OCD, so this is actually, if I reset that, you can see a formula there. And same thing for Open Insider. So yeah, there are formulas there, but because of my OCD, I changed the color to the same color as the cell because I don't want to see those ugly formulas. But yeah, each formula for Yahoo Finance just takes me straight to that ticker. So Generac, you can see it right here, it pops up. I just click that, takes you straight here. So that comes in pretty handy. And, I have it for every single company here, Google, Stellantis. So, yeah, I just use shortcuts there. And, yeah, Open Insider, same thing, basically. Let's see if there's been any buying of Generac, shall we? Only selling. Well, that's not good. Oh, I guess he got a good price up there, $265, not bad. Looks like he just does a lot of selling. Maybe that's how he pays the bills. I don't know. Typically, it's not a good sign, but yeah, we'll see. So yeah, I just like having some of those links here. I might add some more in the future, like maybe SEC filings, maybe the rate to borrow, to how much it costs to short shares, maybe. So I don't know. I just like having a few links here that I can click. Just making it easy to navigate any of these companies and do a checkup on, any new point in the day. Because this is basically, this Watchlist is my main hub, really. So I like to be able to do everything from here. All right, so talked about projected return. We got a whole bunch of different returns here. As you can see, it doesn't mean, not every stock is going to be stellar here. But yeah, this is kind of arbitrary, but again, it's just another checkbox. Here, this goes hand in hand. These two columns here go hand in hand with my projected returns. So this column U is sector return rank. So rank as in like scale of 0 to 100. And this ranks the returns of each stock within the same sector. So for oil and gas, these let's group that by, or sort that by markets. So for oil and gas, you can see all these are being ranked right here because they're all in the same sector. So they're all being ranked to each other. You can see here, okay, now it's like I have a bit more context. Let's say I looked at Chesapeake. Chesapeake 150% upside based on my terribly arbitrary price target. That sounds really, really good. But if we looked at how it ranks against all my other oil and gas plays, we can see that it's only 66. The rank is 66. So you can think of that like 66% sort of, right? It's rank, but yeah, here we have VET is at 100. So this is telling me, wait a second, VET is the best valued oil and gas stock I have on this watch list in the whole energy sector. So maybe that makes me think twice about throwing a lot of money at Chesapeake, right? Even though it looks really nice here. So this is just another indicator, right? And I'll do this for every stock, every sector. And I have these grouped. I have each stock. I have each stock sector noted in another column. So that's one thing that I look at alongside projected return. And then the next column would be classification return rank. So by classification, if we come over here, I mean, what type of play am I categorizing each stock as? So here I have a list. And for me, it's either value in the strict sense of like fundamentals, financials, good. Maybe they're very competitive. Maybe they're just trading at a very steep value compared to the book value, right? So there's value, there's growth, just good old growth. This is a high growth company, like Meta's still considered growth even with all the scare, right? What else? Generac is growth. Google is growth. Microsoft is still in growth mode, So just good old growth stocks, right? Who's going to grow at a really high rate? I try to look for more than 10% annual growth. That kind of checks the box for me. Distressed. Distressed is an interesting one. Here I got Stone Co., which I label it as distressed simply because of Brazil's economy. And then I also have Lumen Technologies is a like a fiber optic cable provider, internet, 5G, that kind of jazz, right? So I think they have a lot of debt. I don't think this 3.8 that's going up. I believe next year that'll be a lot higher, but they're trading a pretty steep value to book value, and they're paying a really high dividend, and I don't think that's sustainable. But there's some interesting things going on. They have high interest payments. They have a lot of debt that they're going to have to service. They have diminishing free cash flow. So I'm like, something's got to give, right? Something's going to happen. But the reason they're on here is because they recently got a new CEO, Kate Johnson, who's a former president of Microsoft US. So I don't think she's messing around. I don't know why she would join Lumen, because this company has kind of been struggling for years. And just the turnaround story has not been working. And I've been following them for a couple years now. And I did trade them. I did collect a good amount of dividends. I made money even though the stock was like slightly down over the course of a year. I made decent money. I was doing the wheel, collecting dividends. And then at some point, I was keeping an eye on those projections. And I was like, these projections, I'm starting to see a trend. They're starting to get significantly worse. So I was like, you know what, I'm out. I think it makes too much sense to get out. Their cash flow's going down. Their debt level's still high. I think they're gonna have to cut the dividend. I don't know what this company's gonna do, right? I think the price is just gonna continue to drop. And then suddenly out of nowhere, they get the former president of Microsoft US as the new CEO, as the incoming CEO. I think that's a pretty big deal. I don't have any other reason to say like, oh, the company's just gonna, full send, right? Like they're just gonna go back to making a ton of free cash flow, and EBITDA is going to go right back up, right? I don't know that. But I find that very interesting. So I actually did make a trade, but and maybe I'll talk about it in the next stream. But yeah, I marked them as distress, but they're on here. They made this, this sort of the final cut, the elite stocks on my watch list, simply because of that CEO. And I know a little bit about the company, having tracked them for a couple years now. So that's an example of a distressed company. Typically, I'm not going to have a distressed company on here if it doesn't seem like there's some kind of catalyst, or potential catalyst that could cause the stock price to rebound, in a big way. So yeah, Stone Co., Lumen, there are the stocks I had on here. I think I did cut my exposure to distressed companies quite a bit, maybe like 3-4 months ago, because I was concerned about the economy. But and I think that was a good move, really good move in hindsight. So yeah, overall, I don't want too many distressed companies, but yeah, that's basically what a distressed company is: struggling, perhaps trading at a deep value to book value, but there might be reason for some good stock price appreciation, in the next 3 to 24 months. Cyclical in the classic sense of cyclical, as in is the industry, the business cyclical. So semiconductors, oil and gas, maybe housing, consumer discretionary to a good extent. So yeah, that's basically what cyclical is. G&V is growth and value. It has its own category because I think it's worth pointing out. So like Nintendo is still on a very good growth trajectory, even though their sales has kind of been hit because of foreign exchange rates, right? But they're going into theme parks. They're pushing forward with cinema. They have a good sales mix overall, like between hardware and software now. So yeah, they should keep growing over the next several years at like double digits, really, when you adjust for the currency rates. Google's another one. I think they're a value stock, but they have good growth. So I got forward revenue CAGR of, this is 3 years, 21%. That's crazy. Still like through a recession. We'll see if that actually holds up. But yeah, overall, growth and value just means I'm expecting over 10% revenue growth going forward, year over year, for at least like the next 1 to 2 years. And based on fundamentals, based on multiples, they are actually trading at a good value as well. So these get a special mention. Meta's still in growth mode. So this year they might struggle this year, but next year, they should be good to go. Hopefully, I guess we'll see, right? Maybe I'll just have to mark this one as value, right? But yeah, we'll see what happens there. So yeah, those deserve a special mention. I think the growth and value stocks for sure. Spec is just speculative. Maybe I don't know why I'm in the stock. I found it and it seems interesting. There might be something going on, but I have no real reason to be bullish or bearish, right? So maybe it's just speculative. I just want to put it on my watch list just in case, right? Just keep an eye on it. Notice right now there are none here, so that one I don't just grab stocks and just buy them for no reason. But that's a category for if I do. Event is if I'm expecting something very specific to occur. So let's say Activision is a good example. They're supposed to be acquired by Microsoft, I think by the end of second quarter next year, I believe, is what Microsoft said. So that's a very easy example of an event-based stock, right? So I'm not looking at them because I think they're trading at a good value or I think they're poised for good growth. I'm specifically looking at them with regards to that particular event. So I think they're going to be acquired. They're supposed to be acquired at like $94 a share or something, and they're trading below 75. So I made a nice little trade there, but I'm going to keep an eye on them. Maybe the stock price rises gradually over time as time passes, and it becomes more likely that the deal is going to go through. I mean, Microsoft, like I don't know if the government's going to turn down Microsoft, right? Microsoft is the government, I think. Not serious. I'm kidding, but yeah, we'll see about that one. That's a good example of event-based trade. Generac, event-based hurricanes, inclement weather, climate change, stuff like that. The heat waves, right? So that's another one there. Olin Corporation, they've been trying to be acquired, unsuccessfully, I might add, but it's still there. I'm gonna keep an eye on them, just in case I hear some kind of rumor or something. So yeah, anything that maybe, I think a common reason would be rumored acquisitions, potential acquisition, something very specific, an event that is highly predictable, right? And this is basically telling me that if the event doesn't happen, there's nothing really holding up the stock price, at least not in my view, right? So if the acquisition doesn't go through for Activision, the price is probably going back down to where it was before. It was like $60 or something. So yeah, so this is it's an indicator that, hey, there might be some good money on the table to be made, but you could lose a good deal if you're wrong. So almost speculative, but I can actually tie it to a specific event. Yield is specifically free cash flow yield. So you'll notice, like, let's see, let's sort by yield. Yeah, it's all oil and gas because oil and gas companies have fat free cash flow yields right now at current oil prices and natural gas prices. So that's basically they are cyclical. So you might wonder, okay, why aren't they cyclical? Because I'm looking specifically at their yields, like first and foremost, right? Like if oil prices stay at a certain level, like say if they stay above $70 a barrel, then I'm looking at this from the perspective of they can still make a ton of money, a ton of free cash flow if that's the case. They're cyclical, I already know that, but the main goal of this play is to buy a stock that's yielding a very high free cash flow amount. So that's just kind of the way I choose to look at some stocks. If it wasn't exactly like an oil and a fat yield play, or maybe it's just way too volatile, and I want to tell myself that, right? Like here, it's like these stocks may be very volatile because of oil and gas, right? But no matter what, I have them marked as yield, and I'm gonna think in my head like, remember the yield. Don't worry about volatility, or if you are, then hedge, right? So I am thinking about the yield first and foremost here. These say like Venom is up here because Venom's been very volatile, and I'm not really that hedged on Venom. So I'm going to consider that cyclicality, right? And maybe I'm going to make it smaller. That might seem a bit arbitrary versus these other oil and gas stocks, but I have specific reasons for that. Here's metals, ArcelorMittal, that I still need to research. Obviously cyclical because they're in steel manufacturing. MHO, home building, Freeport, copper, right? So, those aren't yield plays, but yeah, that's what yield means. Just high free cash flow yield. No matter what, I need to keep that the focus. And if that changes, if those yields drop, or they're projected to be, far less than what I'm estimating as of today, then I got to make a change. Then it's like, okay, this isn't a yield play anymore. That this is my current thesis. So that would change. That would go against my thesis. So now I got to rethink the position, right? So yeah, those are the classifications. And going back to that classification return rank, scale 0 to 100. This is going to rank all of those based on classification that I just went over. So you can see Venom is top of cyclicals, right? If we go to yields, which is all oil and gas, VT is top again. I mean, VT across the board is top. And I've heard some other value investors talk about VT too, which is interesting. So that one's I think it's a very good play. But it is volatile for sure, though. What else do we got here? What about growth? Growth, ESTE, I wouldn't call it a value because it could just suck it up, like the management could forget how to make money, VTNR. But yeah, if they do well, if they do execute on their strategy, there's a lot of growth priced in for this company, and they are actually big on M&A, at least as of recent. So yeah, that might be a part of the growth thesis, if you will. I labeled it growth partly because they're making acquisitions, right? So that's something I have to consider in my valuation. How are they going to pay for those acquisitions? Are they going to issue shares? Are they going to issue debt? So these are things I'm going to be considering, right? And I even put here, here you go. Yeah, I did have a lot of comments for this. Management seems to want to continue acquisition strategy. Debt reduction is priority, which increases the risk of significant share dilution, which I know I included in my assumptions. So yeah, just because it's marked growth over here doesn't mean, hey, throw money at it because it's going to grow. This is also a word of caution. They are going to dilute, right? So that's included in my assumptions. I made that a specific comment. So yeah, just as yield is I'm specifically thinking about free cash flow, and that's the primary point of my thesis, right? Growth, one of the primary points will be, how are they going to pay for that growth? So it's not just a good thing; it could be a bad thing as well. So, yeah, if we look at that CRR classification return rank, Earthstone is at the top. Microsoft is fairly low. Microsoft's on here because, well, it's Microsoft and they're actually trading at I think a reasonable value, to be honest. Palo Alto's on here because I like cybersecurity. Visa's on here. I covered a couple weeks ago, one of the live streams. But yeah, not too crazy about growth right now. I like growth, but I like growth and value a lot better, So these I'll keep an eye on. I'd like the prices to drop a little bit more, But yeah, we'll see. And Generac, maybe Generac hurricanes pass, and I know they're still growing, and the growth picture is still intact. And maybe I'm like, you know what? It's no longer an event-based trade. I still like the stock. They're still going to grow. So maybe I change that to growth too, And how do they look there? 41 rank. So I got a lot of growth stocks that are higher than this. Okay. That are hidden, I guess. So yeah. Google is actually low on the growth and value. What happens if I change that to growth? 46. So Google gets it's a little up there, I guess. Value's pretty low. Look at that. But it's kind of contending with these. Look at this, Stellantis. Stellantis is number one, right? I hope that works out. But yeah. So that's just how I choose to categorize these. How am I looking at these companies? I'm comparing them to other companies that have similar characteristics in terms of projections and maybe competitiveness, but always valuation, of course. So yeah, overall, these, I'm going to consider all of these three metrics: projected return, and then the ranks within the sector, and the ranks based on my classification here. So if I see something like this, like VET, then I might throw a lot of money at them, right? Assuming the thesis is sound and I've done my research and I'm comfortable with the potential volatility or potential risk, right? Stellantis, that's another winner. Look at Meta. I mean, I know so many people hate Meta, but I don't know. Zuckerberg, he's done it before. I think he'll do it again. Earthstone is pretty high up there. Olin Corp, I probably just don't have a lot of chemicals companies that are invent based, so yeah, who knows? But yeah, this is an interesting one. Activision is really low, right? Or overall, but it's not really pricing in the certainty that there'll be that the acquisition will go through. Maybe if I change this to the acquisition price target, oh yeah, so it goes much higher. So in terms of event, right? If I just made that hard coded that as the price target, then it's much higher. So yeah, all right. So let's skip ahead. Spend a lot of time on these first like three columns, or three or five or whatever. Valuation, already touched on this a good amount. Look at the projections, but these are based on the last 12 months. This is just an initial screener. Palo Alto's high because I think I haven't adjusted for the stock split, but that'll, as I put in forward financials, that'll fix itself. Dividend, I always want to see dividend. And as you can see, I have medians down here. You can kind of get an idea for all the stocks, literally the median of all the stocks that I look at. EV to EBITDA 7.9. I try to lean towards some growth, and this might be a little skewed perhaps. Let's see if I drop that down to I don't know. Let's do 80. Okay, that doesn't do anything. Or I guess it shouldn't because it's median. Debt to EBITDA, I like to keep that low, right? As you can see, some of these are going to be out of whack, of course. But yeah, I like to see below 3 times. Price to book, even that's kind of low, even though I have plenty of tech stocks that price to book doesn't even apply to, right? Dividend, as you can see, I do like dividend stocks. I don't look exclusively for dividend stocks, but it is nice, especially when the company's already undervalued. Free cash flow yield, hey, that's above my hurdle rate, right, of 5%. So that's nice. But yeah, and then enterprise value. These are kind of a little more arbitrary medians, but yeah, I do tend to gravitate towards the smaller cap companies, maybe like 2 to 20 billion, maybe. And I don't mind looking at penny stocks either. So very rarely will you find the mega cap stocks like Microsoft, Google. I don't like to look at those stocks too much, but I will if I think there's a good chance the markets are going to trade those stock prices up, right? But yeah, revenue, I like to track year-over-year growth, the 3-year compounded annual growth rate, and then the forward 3-year CAGR. And as I mentioned earlier, I apply the forward 3-year CAGR to this valuation metric that I only use for a few companies. Specifically those high growth companies that aren't too big. Like I'm not going to apply it to Microsoft, right? To me, that just doesn't make any sense. Like they're just massive. What is this? 1.75 trillion dollar market cap. Like to me, it doesn't make any sense. Like, oh, what would the market value this company on? Based on sales. Like it doesn't make sense. It's too damn big, right? So yeah, I'll look at the smaller companies that are still high growth mode, and I'll kind of apply that forward 3-year CAGR to that forward enterprise value to sales multiple. Cash flow from operations divided by revenue. That one's kind of just here just because I want to see if they're profitable based on that. I use cash flow from operations as a proxy for net income, and because this is actual cash, right? I'm always all about cash, and I think everybody should be. I think when news sources are like, oh, PE this, PE that, it's no, you got to look at cash. But yeah, this tells me how profitable the company is. Look at Venom, over 60%. That's crazy. Yeah, this is just a quick snapshot. The previous year and then the last 12 months. EBITDA, this is EBITDA margins. By the way, I like to keep everything on one page. If you notice, I don't have to scroll side to side. So this is everything I want to see like immediately, right? And then I can unhide these groups, all these columns if I want to see more. But this is basically an overall snapshot. So EBITDA margins, this is sort of a proxy. EBITDA it's always an adjusted figure. It doesn't represent actual cash. I just use it as kind of another metric to look at, but honestly, I don't even look at it that much. But yeah, it does need to make sense when I'm looking at enterprise value EBITDA or when I'm looking at the valuation over here, right? So yeah, the higher their margins are, then potentially the higher value the company should be, right? And vice versa. Like, look at Palo Alto. This 2% doesn't mean much to me because I know they have high stock-based compensation, for example. So yeah, this is just another. It's a bit of a reference more than it's going to drive my valuation, drive my analysis. I'd rather look at straight cash and do deeper dive. Net working capital. Well, this is actually current ratio. I just have it as net working capital for reasons. Yeah, I want to look at how liquid the company is, and this is just current assets divided by current liabilities. And some of these companies, depending on what type of company it is, I will do a modified version where I subtract cash from current assets and subtract short-term debt from current liabilities. So that's specifically how I'll look at companies that are just hoarding a lot of cash, and maybe because they don't know what to do with it, or particularly recent IPOs or SPACs. So for those, I don't have any recent IPOs or SPACs on this list, unless I was just shorting them. But for those, you'll see very different numbers, and I'll use that modified calculation, like this one here, for those companies in particular. And you might notice, like, if I apply the regular formula to StoneCo here, it doesn't even make a difference, so it's not a big deal there. But what about ATVI? Let's do it for that one. Okay, so ATVI, that's a good example. 6.2. Let's forget about the potential acquisition. You'd be like, what are they doing with all that cash? Like, that directly represents how much cash they have, right? So something like that, I'm going to modify it and say, guess you're not that liquid after all, Activision, but we know they're probably going to be acquired, right? So kind of a special situation there. So yeah, this is just a quick check on liquidity. And again, I'll adjust that formula if I feel I need to. if it's a SPAC, a recent IPO, they just got a ton of cash, right? So I'm going to adjust that as needed. So yeah, I guess those are the columns. Recommendations here. Long is basically what stocks I'm already buying or I've already bought. Add is, well, let's just do it like this. Okay, so add is a stock that I'm interested in buying, or I already have some, but I want to increase the position. So you see like Stellantis is there, Microsoft. I'm selling puts for like June of next year at like strike 200 or something, and I got pretty good premiums for those. So, so that's an ad, right, for me. Very specific there. Google, I think it's trading good value. Venom, this one I don't know if I actually want to add. So maybe I'll just say long. Yeah, I'll just change it to long because I am loaded up on oil and gas to a decent extent. So yeah, add is just either I don't have it and I want it, or I do have it and I want more. HCC is just hedged to close. That's because I made a trade that basically it's not really going to lose me money. So I made an interesting trade on Lumen. But yeah, I'll talk about that maybe another stream, or if you want to know, just let me know in the comments. Long is I'm just holding the stock, and that's that. I could put hold as in I'm just holding, right? But hold is as in, for me, it's if I don't want to touch a stock, I don't want to buy it right now. It's basically hold equals wait, like don't touch the stock right now. Long is just I'm long. I'm going to stay long for now, right? And as you can see, there are a good amount of stocks here that I'm just long. Half of them oil and gas. But this doesn't accurately represent my portfolio or the weightings or anything. So, for example, I think oil and gas is like, I don't know, maybe 11% of my portfolio, something like that. So it's not that crazy. Research. So these are companies I mentioned in last week's stream: MHO, ArcelorMittal, MT, PVH. So yeah, I still need to look into those. I've been looking into them a bit, but I think I have to read into the 10Ks a bit. So yeah, this is kind of, it's not just like what am I doing, or what am I doing with these stocks? It's kind of like instructions for myself. And then as I do stuff, research, I know I need to look into them. Then I look into them like, okay, then I'm either gonna hold, or let's say I'll hold, and then I'll say, okay, if I'm gonna hold, then I'll just, hide that column. I won't do it right now, I just did it literally. What was that? That was MHO. So yeah, maybe I just decide, okay, I'm just gonna hold off for now. I'll come back later, right? And then maybe later I say, you know what, it's time to either add it, or maybe I need to update. So I'll just mark it as an update, and then there it is. So yeah, I like to use drop down lists. I like to use, as you can tell, conditional formatting. These colors are kind of easy on the eyes. I think I don't like the hard reds, the hard greens, something like that, because I hate looking at those colors. But yeah, it's just more my OCD, I guess. So yeah, this trim, Occidental, I do want to trim it because I've made good money on it. So I'm okay with trimming it. Just free up some cash, Maybe the market crashes. I got some extra cash. I'm going to buy some companies, right? And then watch. Those event-based trades would definitely be a watch. Just going to keep an eye on them, right? Maybe not trade them, maybe I am trading them, but I need to keep a very close eye on them. HPQ, I don't know what to do with that one. It's just, it's trading like a value trap, but it's got a really high free cash flow yield, so I'm just going to watch them, Palo Alto, I did make a trade, but I do want to watch them specifically. So yeah. So that's everything you see here. Let's see what else I want to go into a bit. I'll touch on projections a bit. These are a few more metrics. Cash return on invested capital. Why isn't that? Okay, there we go. I like to look at cash return on invested capital versus typical ROIC or ROE, because this is at hard cash, right? So Yeah, I'm gonna look at the previous year and the current year. Sometimes I'll look at trends, just going further out, right, further back. And sometimes I'll just sort by that just to see like who's in the lead there. Let me change some of this. There we go. Some of the conditional formatting is weird. Look at HPQ, 61% cash on invested capital last year. So I might want to check the long term, right? Nintendo, 32%. Palo Alto, 27%. Meta, 27%. Look at this. That's insane. So dollar made on every dollar invested into that the company has invested, So it's crazy. Go figure that Google, Microsoft, Meta, those companies are up here, right? So yeah, I'll look at that specifically. I might even switch that with cash flow divided by revenue, but yeah. And this is just this is different free cash flow yield, unlevered, I guess. Right, unlevered. I think it's unlevered. Yeah, sure, why not? Okay, so these are the projections. So this whole section right here are my projections or pro forma if I already have say a company's merging or being acquired and the debt structure is going to change or they're going to issue shares, right? But pro forma I would typically put in like this green color, like so. So but yeah, that's what I would do for pro forma. It just makes it obvious for me. So projections, everything here, as I've mentioned in the other videos, I get from ticker.com. And let's say if I bring up ticker, let's look at, let's see what we got here. Maybe projections have changed for, why don't we check Generac? Let's check Generac. Generac, I see. So I might say, let's go to estimates. So I go here to look at estimates. I'll hover over the estimates real quick for the next year, 2023. Revenue, 20 estimates. EBITDA, 18 estimates. Free cash flow, 11 estimates. Good enough for me. And these are aggregates of Bloomberg estimates. So this is coming straight from Bloomberg. And again, I'll take these with a grain of salt, but that's a good amount of estimates. So yeah, I think that could provide a decent baseline, right? And then maybe I just want to go conservative for like a margin of safety, right? So let's say I'll look at split the windows here. How do I? Okay, let's just do that. There we go. I usually use a whole separate monitor to do this at the same time, but you wouldn't be able to see it. So okay, Generac. All right, let's check their estimates, see if we need to update anything. So that's the same. 1321, that's the same. Okay, looks like it's the same. So no need to change. What else? Maybe copper. Let's check FCX. 2023. Okay, that's the same. I guess I just updated these. I don't need to change anything. Look at that. Let's try to find one. Visa. No changes. That's okay. Whatever. But I will check these probably on a weekly basis. And they don't change necessarily like every week. But yeah, I will check these estimates just to see if anything's changing. I'll keep in mind the trend, if the estimates are going down. But these are for 2023, like I said earlier, a year to a year and a half out. And what I like to do is if I'm cautious about those estimates, I will use this little sensitivity factor, what I call it. Default is 1, and all this is doing is multiplying every estimate by whatever that number is. So if it's 1, then it's keeping it the same, right? But let's say if I want to be conservative, like for Earthstone, I got 0.8, so it's multiplying each of these by 80%. So that's just me dropping the estimates just because I want to be extra conservative, because I'm typically pretty conservative. So I could do that for any of these, and it will in turn, let me close this. It will in turn affect these forward multiples, which are what's driving the actual valuations and the price target over here. So everything I mentioned earlier, the valuation, the price target, the ranks, the return, potential return, sector, return rank, all that crap, it's all being derived from these multiples, all these multiples right here. So, but yeah, if you'll notice, like if you keep an eye on, say, FCX, enterprise value sales 1.9, enterprise value EBITDA 4.4, debt to EBITDA 1.2, free cash flow yield 9.6. So let's say I change that to, let's say I think copper price is really going to drop. So I'm going to penalize the estimates by 50%. So 0.5. Now look at those multiples. So everything doubles, right? So that makes sense. Free cash flow yield almost gets cut in half. Or I guess I had it at 0.8 before. But yeah, so not only, like if you notice, not only do these change to reflect my new conservative estimate, but if you look at the price target, my price target over here, it goes from 30.9 to 25.8, which is below the current price. So if I do this, if I'm really concerned about estimates about a company going forward, it's a cyclical stock, right? Or just anything can happen, right? Or a recession. I'm going to do this and I'm going to see, okay, what's my downside scenario? Like, what's the downside case? How much money will I theoretically lose if estimates really drop? So yeah. And again, it's not a science. These are all just estimates, you know? And this is going off of 2023 estimates for the full year, 2023. So I'll just put back up to 0.8 and yeah. So yeah, these are the same multiples I mentioned earlier. I do look at dividend payout ratio, but I divide the dividend by the free cash flow instead of net income. I just prefer to do it that way. See, like Lumen, 102%. So what are they going to do? They're going to have 5.4 times debt to EBITDA, forward EBITDA, 102% payout ratio, free cash flow. What are they going to do? They're going to have to cut the dividend or issue more debt. And they're going to issue what? They're going to go to 6 times leverage, you know? So, yeah, that one's interesting, huh? HBQ, 22% dividend payout, you know? So, Chesapeake, they got a really high dividend rate, but it's only 27% of expected free cash flow. So yeah, some interesting things going on here. But yeah, these things I like to track. This would be forward enterprise value. And the last thing I'll point out is I like to look at their share buyback rate. So here, if it's positive, that means they're buying back shares, and the shares here will reflect the buyback rate that I list. And this is going to be based off the historical buyback rate or what they've mentioned it will be going forward. So HPQ, they've had like a 10% buyback rate. Something, it's just ridiculous. They're going to buy back the entire company in like 10 years. But it's been 10%. But I'm like, you know what? I'm going to be very conservative. I'm going to cut it in half. So 5%. So all these multiples, this valuation is reflecting a 5% decrease in the total shares outstanding. So basically, the company's just getting smaller and smaller, so each shareholder is owning more of the company. So you can see, if I were to, you can see like the changes if you look at, say, like price target and some of the other multiples. If I put this at the 10% rate that they're talking about, let's see, target price goes from 39, it goes up over $1. So about $1, was that $1.13? So that's pretty good compared, $40.11 compared to sub 25 right now. So yeah, I'll still be conservative there, but and as you can see, like some of these, I'm just basing it off of like their actual historical buyback rate. Like MHO, this is like the past 2.5 years, and I'll just do like a CAGR formula. And then just to be conservative, I'll cut it in half. Is that 0.5 times the actual buyback rate from the past 2.5 years. I use 2.5 years because we're halfway through this year, right? I could use 3 years or whatever. But yeah. So some of these are really high. Nintendo's got a high buyback rate. Occidental 1.5%. It's pretty good. What's this? PVH. It's pretty high. And then it's negative if I think they're going to issue. So Earthstone, I am being very conservative, and I assume they're going to dilute the hell out of shareholders because they're going to want to keep acquiring, assuming oil prices remain at a decent level. So, yeah, that's 38.5% dilution, I'm assuming, and the stock is still so undervalued. So that's crazy. Notice if I change this to 0, 108 million shares outstanding, and that price goes, I think it goes way up, doesn't it? Yeah, so it goes up like $10 if they don't issue any shares. But I'm just going to assume they're going to issue shares, So that's a big penalty for them. And they're still undervalued, so it seems, right? Hopefully they don't, again, forget how to make money like some other company did, VTNR. Activision, just in case they don't get acquired, they're going to keep diluting, bit by bit, probably because of stock-based compensation, right? So yeah, I try to incorporate that in valuation, into projections. I didn't always do that, and I guess if you keep an eye on these price targets over here, you'll see, let me get rid of all these percentage changes in shares, right? So keep an eye over here. What happens if I get rid of all this? You can see how they change. So, yeah. Some of them, they hardly change at all. Some of them, it's a big deal, right? So, yeah. So I like to calculate that. If the company has a history of doing it, or if the company's like, we're really going to ramp up share buybacks, then I want to pay attention to that. So yeah, everything over here, it's just financials. These are financials I focus on. Past 5 years of revenue, profitability, operating margin I like to pay attention to, and I'll check ROIC.ai as I mentioned some other videos. Look at Microsoft real quick, financials. So yeah, operating margin, I like to look at this long-term trend in operating margins just to look for some consistency, right? And I've mentioned that, but yeah, I'll track that here just for the last 12 months mostly, or this is for the prior fiscal year rather. I'll look at EBITDA, and all of this is just feeding all these other formulas. None of this is automated. I'm putting all these numbers in myself. I kind of like to do it that way. I'll probably automate it at some point, but this way I see all the numbers basically one by one, and sometimes that tells me a lot. So, and sometimes I leave little comments. I'm looking at like pensions for HPQ, for example. But yeah, so essentially the metrics that I'm tracking, the financials I'm tracking, are the ones I need for all of these formulas. That's it. So cash, current assets, short-term debt, total debt, current liabilities. So liquidity and leverage, that's the big thing, right? It's always about liquidity and leverage. Cash flow from operations, CapEx, net debt repayment, and then here you have all the sectors that I mentioned earlier. I have this earnings column, but it's not really working correctly, so I'm just kind of ignoring it for now. But yeah, that's pretty much it. All these financials you can get from ticker.com, or you just straight at the 10K. But which I will if I want to do deep dive into a company rather than just screen. So this is mostly just part of the screening process. At least, as far as putting in all these numbers. And basically what you see on this screen is like the everlasting watch process, the watch, why it's called a watch list. So, yeah, that's basically it. I guess I'll point out one other thing and then we'll call it a day. I do look at average industry multiples. I get these from good old Aswath Damodaran. And I'll include a link for this. I think I put it in another video, but I'll just go ahead and include another link. Or I'll put the links in this video as well. And this will drive like my expectations for valuations, specifically enterprise value to EBITDA. And these are just average historical multiples that each industry trades at. So I'll apply those particularly for like cyclicals, because it gets really weird for cyclicals. But so yeah, there's that. And then there's another spreadsheet where, like, if you don't know what industry a company's classified as, you can look it up here. Like, say, I don't know if Venom is upstream or downstream, right? Then look for Venom here. It doesn't exist. Where is it? Okay. What about, let's see, let's do global by industry. Is it here? It's not here either. Okay, let's do VET. Is that here? It's thinking. Okay, there it is. Wait. Oh, this is a lot. Let's do another one. Oxy. We don't know what Oxy is, right? Man, I didn't think. Okay, let's go back to US. Let's see if we can find it. Okay, there we go. Okay. Oxy, according to this, oil and gas, it's oil and gas integrated. I think ticker says it's like downstream. Or I think it's like production and exploration, isn't it? Let's see. Like specifically? Gauge the acquisition, exploration, development. So yeah, that's upstream. I guess they have some midstream part. Okay, they do have some midstream. Okay, so I guess that's why it says integrated. So yeah, you can find stuff like that. There's a bunch of actual upstream companies, production, exploration. So yeah, is Chesapeake on here? There's Chesapeake. Chesapeake is upstream, production, exploration. So yeah, you can look by U.S., by the globe. You can look alphabetically at all the companies. There are a ton of companies here, but yeah, I'll include those in the description. And yeah, that's about it. It's probably a lot, but again, if you have any questions, just let me know in the comments. I know there's a lot of stuff, but I just wanted to keep it at a high level, just to kind of show you. Really, like, this is a very personalized process for myself. There's a lot of stuff that goes into these formulas. Vast majority of them come from Google Finance. And yeah, I just kind of wanted to give you an idea of what I keep track of. Hopefully that helps you figure out what you need to keep track of for yourself. So yeah, let me know if you have any questions in the comments. Again, if you haven't seen the other videos, particularly the video on value investing, on my style, and how I actually screen for companies, and all the sources that I use, check out those videos. Check out the intro video, the disclaimer while you're at it. Why the hell not? And yeah, I'll probably do another video either Thursday or Friday. And from here on out, it'll be mostly just like value investing or just stock analysis. Probably what you're used to seeing on YouTube. But I'll kind of use like my own specific approach rather than just say like this stock is a buy or this stock is a sell, stuff like that. So I'll try to focus more on that. I'm also trying to make the video shorter. So this will probably be the last very long video you watch. Hopefully that helps y'all out. So yeah, again, if you have any questions, let me know in the comments. Thanks for watching. Stay tuned for the next video. Hopefully Thursday, maybe Friday if I'm a bit late. But yeah, until then, I'll see you guys and gals. Try not to lose too much money. The markets are crazy. But yeah, have a big cash just in case the markets drop. Start have your own watch list. See what stocks are undervalued based on your analysis, right? And just be ready to snatch them up, So yeah, that said, have a good one. See you guys in the next video, and cheers.